what you've got basically going on in the world economy, big picture, is you've got a bifurcation of the world monetary system into two, if you like, subsystems. One is a US system that is backed by treasuries, but those treasuries are wrapped in stablecoin. Okay, so effectively, it's a digital collateral, if you like. And then what you've got in China is a paper yuan system that is increasingly backed by gold, and therefore you've got a gold-backed or quasi-gold-backed system in China.
In recent months, one of the most troubling changes in global finance has quietly unfolded in the background. The U.S. government, through the so-called Genius Act, has opened the door for digital assets like Tether and USDC to become deeply embedded in the American financial system. What was once sold as a harmless crypto innovation has now become something far more dangerous, a private pipeline of digital credit propping up U.S. debt. Instead of relying on traditional foreign buyers, Washington now gets a steady flow of demand for its treasuries through the stablecoin market. On paper, it looks clever. In reality, it's an artificial support system, a shadow version of dollar demand that keeps the system running while masking its underlying weakness. Stablecoins are no longer just digital cash. They've become a new instrument of control, one that lets the U.S. extend its debt empire into cyberspace. And other nations are taking notice. Across Europe, the European Central Bank has already warned that US dollar stablecoins could threaten their monetary sovereignty, essentially giving citizens an American-backed digital deposit alternative. In Russia and China, policymakers see the same pattern, a new way for Washington to export dollar dominance, only this time through the blockchain. By wrapping US treasuries in digital tokens, the U.S. has managed to digitize its debt and distribute it globally. Analysts are calling it a digital dollar empire. But behind the shiny language of innovation is something much simpler. It's another attempt to delay the consequences of too much borrowing with one more layer of financial engineering. Meanwhile, China has gone in the opposite direction. Instead of chasing digital hype, it's quietly anchoring its system in real assets, mainly gold. The People's Bank of China has been buying record amounts of gold, preparing for a world where trust in paper money fades. And they're not alone. Around the world, central banks are increasing gold reserves while the West pushes digital debt products. So, while Washington turns to blockchain to extend the life of its fiat system, Beijing seems to be preparing for what comes after it, a return to tangible value. This brings us to Michael Howell, CEO of Cross Border Capital. In his view, the world is splitting into two competing systems. One is backed by digital treasuries, that's the American model. The other is backed by physical gold, that's China's approach. Both are racing to control the future of global money, but their foundations couldn't be more different. And according to Howell, this isn't just a technical debate, it's a fight for global trust. The US is betting everything on digital paper. China is betting on metal you can hold in your hand. Before we go deeper into Howell's reasoning and what it means for gold and silver, make sure you're subscribed and hit the like button if you value straightforward, fact-based analysis. We appreciate the support and hope you enjoy the video.
What this really comes down to is the effect not stablecoin on the domestic US economy, but much more on the international economy and the funding that this could unlock for the US government. Now, already the ECB has said, well, this looks unfair to us. US stablecoin could be a threat to the European monetary system because we would lose control over monetary policy in the Eurozone. And I think that's a realistic threat. Now, it may well be that, we're debating the degree. Maybe it's a gray area. Maybe the ECB loses control of 10, 15%. Maybe more percentage of deposits, but it still could be a meaningful amount because European residents could think, well, okay, if we put money into stable US dollar stablecoin, potentially it's anonymous, or it gives us one line of defense here. It may be that we can hide it from the tax authorities more easily. I'm just supposing the arguments that people would present, or at least it's outside of European jurisdiction, and we feel more comfortable holding US dollar assets in this form rather than a bank. And again, I'm just proposing arguments that could be made here. That could be the incentive. And it isn't necessarily the case that these stablecoins do not pay interest or do not pay an income, because they could basically, as is being mooted already, give a fee rebate, so-called fee rebate, which gets around the legislation of paying interest. Although, as I understand it, the inability to pay interest is only for US residents, not for foreign residents, but that's a detail. But the bigger thread is not for Europe, it's for the rest of the world, because Europe has the euro, which is at least a decent and viable currency with some integrity. Once you start thinking about African currencies or Latin American currencies or other international currencies, then you start thinking, well, actually, the residents in these countries already hold dollars. They're constrained by the lack of paper supply. If they've not got access to stablecoin, they're going to move with alacrity and size into the stablecoin market. And that would mean that effectively the world dollarizes very quickly. Now, I wouldn't rule that out as a possibility, because I think it's very realistic. And I think it's particularly a threat to China. Because what we know is that if, for example, hypothetically, you took capital controls off of China, what would be the direction of capital? It would leave in big size, in my estimation, okay? Now, if you start to think this through, and you've got a situation whereby Chinese exporters have already got a lot of dollar deposits, they're feeling slightly uncomfortable, given the precedent about the sequestration of Russian assets after the invasion of Ukraine, holding it in Western banks, whether it be European or US banks. They feel uncomfortable about that. They can hold it in stable coin. And it's a lot easier to open a stable coin account than it is now to open a bank account. So that could be done. And there is some degree of anonymity in holding those stablecoin. I'm not going to say exact, but there is at least some degree of anonymity that could cause them to shelter that. And I think from a Chinese exporter's point of view, if you've got a lot potentially of dollar revenues, and even despite the tariffs that have been imposed, China's trade surplus in dollars has gone up, not down. So think that one through. So they've got to have somewhere to put those dollars, and stablecoin could be the answer. And we could be talking about a huge size of inflow. The Chinese authorities are worried. They're worried simply because they would lose control of the Chinese monetary system. There is a discouragement, from the point of view of a Chinese exporter, or there's it's a choice between what they call the devil and the deep blue sea. Do you put it back into the Chinese banking system, put your money back, convert it back into yuan, and hold it in the Chinese banking system? Probably not, because then you could get that sequestrated if you behave like Jack Ma and become persona non grata. So that is ruled out. So stablecoin are the obvious answer. And I think that's what China is panicking about. And what you've seen in China this year is a very significant change, which I'm about to show you. Sorry, that's this chart. And this is showing People's Bank of China's liquidity injections into the system. Now, I think this has spurred China. Anecdotally, but unofficial anecdote would suggest that policymakers are running scared. And what they're doing now is they're trying to shore up the Chinese financial system and to get out of the debt burden, which is really impairing it. China has a huge debt problem, as we know, that is creating deflation in the system. The only way there are two ways you can get out of debt, I should say. One is to default. But as I've tried to argue, you can't default in the modern financial system, because effectively liquidity or credit is debt. So everything is sort of rests on everything else. So you simply can't default unless you want to end your financial system and your economic control. So they can't default. Second option is to print money and devalue it. And that's what they're doing here. So they're trying to dig themselves out of this debt grave by printing lots of money. And let's just see this chart here, which is looking at the debt liquidity ratios between Japan and China. Now, Japan has managed to get itself out of its debt problem to an extent. The black line is looking at the debt liquidity ratio of Japan. I look here at debt liquidity, not debt GDP. A lot of economists look at debt GDP. I'm not sure why. I don't know what it really tells you, apart from the fact that the number is going up. But debt liquidity is a meaningful statistic because it mean reverts and it shows the ability to refinance debt. And what you can see in the period from about 2000 through 2010, Japan's debt liquidity ratio was sky high. That was impairing the economy. The economic performance was a big drag on Japan's economy. And what they've done through Abenomics and through the purchases of JGBs by the Bank of Japan, what's happened is that debt burden has come down. They've basically inflated their debt away, and you can see the debt liquidity ratio dropping back. Liquidity has been created in size, and the yen has devalued dramatically. Okay, that's the story. Look at China, the orange line. China is about 10, 15 years behind Japan. And what it's trying to do now is exactly the same thing. So what you're seeing is the Chinese yuan devaluing. But as I've said before, don't necessarily look at the yuan US dollar cross as your marker here, your benchmark. Think about the yuan gold price. And I've tried to show this in this chart, which is always out of date because the line moves up and down so dramatically. But this is really trying to show what the Chinese have been doing. And it's no mistake that the Chinese are actually buying gold as well, because it's simultaneously shoring up their financial system and giving them some cushion against this devaluation. But what they're doing is they're trying to reduce rather the nominal value or nominal impact of Chinese debt, particularly real estate debt. So what you've got to do is to devalue your paper assets, i.e. the yuan, against real assets, i.e. real estate or gold.
As Howell explains, this isn't just a crypto story. It's a story about how the US has quietly rebuilt the plumbing of its debt markets. By tying stablecoins directly to US treasuries, America has created a new way to fund its deficits without relying on foreign governments or banks. But there's a catch. These tokens circulate beyond any real oversight. In emerging markets, where local currencies are weak, businesses and individuals are moving into digital dollars. That may sound convenient, but it's also spreading a new wave of dollar dependence. For Washington, that's a win. For everyone else, it's a slow erosion of monetary control. Europe and China see this clearly. The US has managed to repackage debt into a tech product and export it globally. Howell warns that this structure makes the world far more fragile. If confidence in digital assets or the underlying treasuries ever breaks, the contagion could spread faster than any traditional banking crisis. That's why China's response makes sense. Rather than play the same digital game, Beijing is diversifying away from the dollar, weakening the yuan deliberately, and stockpiling gold to stabilize its system. The result is the beginning of a monetary split. The West, built on digitalized debt. The East, built on physical collateral. Two systems, two definitions of value. Only one of them is real.
What you've got basically going on in the world economy, big picture, is you've got a bifurcation of the world monetary system into two, if you like, subsystems. One is a US system that is backed by treasuries, but those treasuries are wrapped in stablecoin. Okay, so effectively it's a digital collateral, if you like. And then what you've got in China is a paper yuan system that is increasingly backed by gold, and therefore you've got a gold-backed or quasi-gold-backed system in China. So you've got two ultimate collaterals. You might say digital assets for America, re-Bitcoin, and gold in China. And therefore we've got to start thinking seriously about diversifying into those two assets, not as alternatives, but as complements. You want gold and you want Bitcoin. You don't want one or the other. And that's really the story.
Since the West, and we'll just resume it very simply with the G7, who hold about, I think more than 50% of gold reserve worldwide officially, wouldn't they also be keen or interested to follow suit and devalue paper against gold, that they ways of offsetting the debt as well?
Well, I wouldn't necessarily rule that out. And I think that what I'm suggesting here is a sort of polarization of the system into these two assets. And I think you could legitimately argue there'll be shades of gray. But then I could say that if this is a competitive situation, a capital war, and we've stressed the idea that, the trade war, I'm not going to dismiss it as being unimportant, but it really is the veneer on top. And what you've got to think about is what we're really fighting is a capital war. It's a battle for the control of capital in the world economy, not about trade patterns. It's about ultimately capital. And, China wants its capital to be in control. America wants its capital to be in control. And that is really, if you like, the vent is currency, or you can think of it in currency terms, I should say. So if you want to undermine the US dollar with its digital collateral, what China's got to do is to try and undermine the integrity of a digital coin. And that may be attacking a blockchain system, or it may be trying to do cyber threats, whatever, because the more disruptive you are in digital technology, the less comfortable people may be holding these digital assets. So, the advent of quantum computing and the advances China is making in that sphere are probably ultimately a threat to the dollar-based monetary system looking into the future. Equally, America will then think, well, okay, it's in our interest if China is backing things with gold, or it's got a lot of gold. We don't want the gold price to go up because it's giving China more power. So what they really want to do is to, if you like, stabilize or reduce the gold price. So what I'm saying is I don't know who's going to win this battle, but you're likely to get a lot of volatility on both those two asset classes. They may trend higher in the long term. They should do, because we're in a fiat world, and those are basically collateral hedges. But you're going to get volatility between these two areas, as sometimes the US is in control and sometimes China's in control. But, the one thing that you won't get, I absolutely guarantee, is a return to a gold standard. And some people are arguing that this move by China to accumulate gold is a return to a gold standard. It definitely is not. It may be giving a connection to gold, but they can't go back to a gold standard because it would tie the hands of the monetary authorities in terms of financing the government. A great power such as China or America simply cannot afford to go back to a rigid monetary or digital standard. You simply can't do it. You couldn't fix the dollar to Bitcoin in the same way as you couldn't fix the yuan to gold. It would be impossible because you'd lack, if you like, the ability to change fiscal policy. And that's what they need to do, particularly if we're ever get to the stage of being in a kinetic war. I think the trend in both gold and Bitcoin is really well established. I think you've got strong, compelling trends there because we're in a world of monetary inflation. And therefore, what you've got to do is to buy these things on dips. And a sort of a final comment is, if you really want to look at the long-term prospects, start to look, I'm going to show you an earlier chart. This chart is looking at the structural deficit in the US economy. Now, the structural deficit, the orange line, is shown as a percent of GDP. And that is basically careering towards levels of 10 to 12% of GDP each year by 2050. These are not our figures. They come from the Congressional Budget Office, which is a bipartisan body in the US. The only change we've made to those figures is we've put a slightly elevated number for defense spending at 5% of GDP, because that's the NATO target. But otherwise, we take their numbers. And what you can see is the structural deficit, which is 4 items: Social Security spending, Medicare, the interest bill, and defense. No discretionary spending at all. That's what you get on the fiscal deficit. The dotted line is debt held by the public, which you can see on that right scale, balloons up to 250% of GDP by 2050. Now, the Congressional Budget Office has a similar projection of a very similar figure. So our numbers are not out of line. What does that mean? Well, this chart is saying, look, let's just make an assumption here. And let's make an assumption that the gold value of US government debt does not change from now until 2050. What would the gold price have to be to match that increase in debt? And what you see there is the implied gold price. Now, that means that gold hits 10,000 by the mid-2030s and prospectively could get to $25,000 an ounce by 2050, okay?
In Howell's framework, this is no longer a simple East versus West issue. It's a competition between digital trust and physical proof. The US wants the world to believe in digital collateral, tokens and promises backed by debt. China wants the world to believe in gold, an asset that doesn't depend on any one central bank. Both sides are trying to attract global capital. But in the long run, trust flows to what's real. And as debt continues to balloon in the West, Howell projects gold will need to reprice dramatically just to keep the system balanced. Based on his structural models, he sees $10,000 an ounce by the mid-2030s and possibly $25,000 by 2050, not because of speculation, but because debt will force collateral to revalue. And that's the heart of the story. Stablecoins, digital dollars, tokenized treasuries, they're all attempts to preserve a failing system. But gold and silver represent the return to truth in value. When confidence breaks, people don't run to code. They run to something they can hold. So as the West keeps digitizing its debt and calling it innovation, the East keeps stacking gold, and history suggests the latter wins every time. If you found this analysis helpful, don't forget to like this video, subscribe for more deep dives on gold, silver, and global markets, and share your thoughts in the comments below. Thanks for watching, and remember, in a world full of digital promises, real money still shines the brightest.